Hello everyone, this is Hiten Gala from the Sharekhan Advisory team. Friends, the Festival of Lights is around the corner and Sensex is almost trading close to the all-time high. Yes, there were good steps with the RBI. Governor has taken the recent steps regarding the easing of the liquidity and the cost of funds has played well for the markets. Also, the strong global markets and the stability of the rupee that we have seen around 61-62 has brought back the confidence for the FIs, and also we have seen strong flows back into the Indian markets. Going ahead, yes, there are challenges as far as the Indian economy is concerned, but one should not lose the sight to some of the strong fundamental companies which are available at good valuations in the current market scenario. Friends, this Diwali we have come out with 10 investment ideas which can be looked upon for the period of next 12 months. Let's have a look to some of the fundamentals and the technical rationales behind these ideas. The first investment idea is Larsen & Toubro. While the overall macroeconomic environment, as we all know, has been tough, but Larsen & Toubro has been able to exhibit an impressive performance in terms of winning the orders, which depicts the credibility and the ability of the company. We also believe that the company is all set to achieve its targeted revenue guidance. However, it might face some challenges as far as the OPM is concerned, but overall we remain positive on the company considering its ability to withstand the overall economic current downturn which we are experiencing. As far as the overall annual order inflow guidance is concerned, we are expecting the company to achieve its guidance of 20% in FY 2014. The current order backlog for the company stands at around rupees 1,76,000 crores, which is reflecting an impressive book-to-bill ratio of 2.9 times. During the analyst meet conference call after the quarter to FY 2014 results were announced, the management has reiterated that the overall order inflow guidance of 20% and the revenue guidance of 15% for FY 2014, which looks likely to be achievable. Thus, we remain positive on the stock and we maintain a buy recommendation with a price target of rupees 1,030. Let's have a look at the technicals for Larsen & Toubro. Looking at the chart, the support 1 for Larsen & Toubro is around 890 and the second support comes at around 830. Similarly, the resistance R1 is 1030 and the second resistance is 1105. The next idea is Colgate India. Friends, we prefer Colgate India in the FMCG pack because of the better growth outlook that the company has been given, and also the overall better performance the company has given in terms of the volume growth is around 9 to 12%. The company has consistently maintained its volume growth for several quarters around 9 to 10%, and the consistent shift from the tooth powder to the toothpaste and improving the rural penetration would help Colgate to achieve 9 to 10% volume growth going ahead. Colgate India, as you all know, is a market leader of around 50% market share in the toothpaste segment and is in a much better place to pass on the input cost pressures by selectively price hikes going ahead. So we prefer Colgate India in the FMCG space. Let's have a look at the technicals for Colgate India. Looking at the chart, the support for Colgate India is 1205, which is the first support. The second support is 1125. The first resistance R1 is at 1300 and the second resistance R2 is 1386 for the stock. The third idea is ICICI Bank. ICICI Bank is the second largest private banks in terms of market capitalization. The market capitalization is almost over 1 lakh crores as on September 2013, and in its CASA ratio is highest among the private banks to around 43%. The capital adequacy ratio as per the Basel II norms is highest at around 18.35%. As far as the quarterly numbers are concerned, the last quarter company came out with some very good numbers with its operating performance and also the overall revenue driving the growth. In our view, the improvement is in the deposit profile is structurally positive for the NIM's outlook, and we continue to believe that the asset quality challenges for the bank will be within the manageable limits. Overall, we are expecting the bank to maintain the return on assets of around 1.6%, and we maintain a buy rating on the stock with a price target of rupees 1,195. ICICI Bank technically has a support of 980 and 891. and the resistance is at 1104 and 1239. The next idea is IDFC. IDFC is one of the leading infrastructure financing institutions that offers a wide range of the financial products and fee-based services to the infrastructure projects and their sponsors. IDFC has a clean operations, good management and pure financial operations, and makes one of the best candidate to get the banking license, which is likely to come out in the next few months. Currently, the IDFC's loan growth is subdued as the overall investment in the new projects is weak in India. But however, the recent initiatives like the restructuring of the SEBs, offer fuel security to power projects and plan for compensatory tariffs are positive for the company. The management has highlighted that the bank license will help IDFC to diversify operations, and that while a transition will drag the ROA, its ability to increase the leverage will support longer term ROE of around 15 to 16%. After the recent reduction that we have seen in the FI limit for IDFC, the stock has corrected, and also it is now available at a good valuations of around 1 times FY 2014 and 0.9 times FY 15 price to book. So overall, it's one of the best pick which is available in the current scenario. Let's have a technical view on IDFC. The first support is around 90, where we look at the chart, the stock has fallen and has taken support at 90. The second support was 80, which we have seen the recent low, which is the stock has made. Similarly, the resistance is now at 120, and for the resistance 2 is 135. The next idea is UltraTech Cement. UltraTech Cement is our preferred pick in the cement pack because it's one of the India's largest integrated cement company with approximately 54 million tons per annum cement capacity. It has a potential to increase the throughput without incurring any major capex by increasing utilization and blending, along with the locational advantage given its flexibility to either export or sell it in the domestic market. Post the weak pricing environment that we have seen during the monsoon, the cement prices and the demand are likely to now pick up post-monsoon across the India. So UltraTech is our preferred pick in the sector, and due to its strong balance sheet and the pan-India presence. For UltraTech Cement, technically the stock might find a support of at around 1,882, and below that 1,802 is second support. Similarly, the resistance 1 for the stock is 2054, and R2 is at 2154. The other idea is Sesa Sterlite, which is one of the largest diversified non-ferrous metal companies in India, with operations in aluminium, copper, zinc, iron ore, oil and power. It is a subsidiary of the Vedanta Group, a London-based company controlled by Anil Agarwal. Worst of the regulatory environment is likely to be behind us, and which has impacted the company. At one point of time in the recent past, Sesa Sterlite, iron ore, copper smelter, alley and power operations were effectively non-operationals because of the variety of the regulatory reasons. But in our view, the worst seems to be over, and from here on, iron ore should restart in Goa, though we are building a smaller ramp up in the FY15 expectations. In our view, the depth has peaked out at the holding company with capex cycle coming to an end. The remaining project capex is conditional on the clearances of the necessary regulatory approvals. We believe that Sesa Sterlite is one of the few stocks where we see a limited downside and could see further re-rating with large embedded option values for the investors. For Sesa Sterlite, the technical view is finding a support at around 189. Second support is 171. The resistance 1 is 217 and resistance 2 is 251. The next idea is United Phosphorus. United Phosphorus is a leading global producer of crop protection products, intermediates, specialty chemicals and other industrial chemicals. United Phosphorus has presence across value-added agricultural inputs ranging from seeds to crop protection products and post-harvest activities. Its revenues are likely to grow by around 12 to 15%, and the EBITDA margin is expected to remain around 18 to 20% in FY 2014. It has also started to focus on the premium products in agrochemicals and will slowly stop selling the commodities and the low margin products. As far as the results are concerned, the company came out with some very robust results for second quarter FY14, and the positive commentary that we have seen by the management on the demand outlook this fiscal and attractive valuations leave a lot of scope for re-rating for this stock going ahead. So we have a very positive outlook on the company, and we prefer the next idea as United Phosphorus. Let's have a look at the technical view for United Phosphorus. The support 1 is at 150 and support 2 is at 144. Similarly, we have a resistance of around 171 for the stock, and the R2 is at 181. Tech Mahindra is our next idea for investment. Post-merger with Satyam, Tech Mahindra has become the India's 5th largest IT company in the country with revenues of around $2.7 billion. Going ahead, the firm is targeting the revenues of around 5 billion worth of sales in FY 2015. For the last 2 quarters, Tech Mahindra has won around 6 large deals, and we believe that Tech Mahindra's revenue momentum will pick up over the next few quarters as it executes these deals. Since last year, Tech Mahindra has shown aggression with respect to the acquisitions to drive the growth. At the end of June, the company has had a cash of around 3,600 crores, and the merger will create treasury shares worth another rupees 3,000 crores. So this is considerably a very large cash reserve the company has, as compared to the annual sales of around 16,000 crores of rupees. Given its relatively large size and management quality, we consider the Tech Mahindra as a solidly placed stock and provides entry opportunity at a very attractive valuations. The company at the current market price of around 1515, it is trading at around 12.5 times and 11.5 times the estimated EPS of FY14 and FY15. Technical view for Tech Mahindra, looking at the chart, the stock might find a support at around 1440. If that breaks, then we might find a support at 1365. The resistance is 1600 and R2 is 1735. Our next idea is CMC, again from the IT pack. Under the Tata Consultancy Services parentage, CMC has transformed itself from the low margin information technology equipment provider to a well diversified IT services and solutions provider. Another favorable factor for the company is that it is driving the strong growth, and it is helping to tap large government projects, as its previous status was a public sector undertaking, and which has given an edge over the other players. As far as the revenues are concerned for FY 2014 second quarter, we have seen that the revenues went up by around 15% quarter on quarter to 560 crores, which was ahead of our estimate of around 536 crores. The company has maintained its confidence of surpassing the NASSCOM's guidance of 12 to 14% for FY 2014. On a longer term perspective, we remain positive on CMC given its strong earnings visibility and the overall valuations. For CMC, technically, the first support is 1276 and support 2 is 1220. The resistance for the stock is 1424, and above that we might find 1509 as second resistance. The last but not the least, Divi's Laboratories is our last investment pick in the Diwali picks. Divi's Lab was established in 1990 with the R&D as its prime fundamental focus and on developing new processes for the production of active pharma ingredients and intermediates. The company is awaiting the US FDA approvals for 3 production blocks at its DSN Special Economic Zone facility, which are likely to come in the second half of FY 2014, and that will help to ramp up the sales in the US market. Divi's Laboratories continues to hold the leadership position in the CRAMS space on the strengths of superior chemistry skills and the ability to serve an entire research and development value chain. We are expecting the revenue and the net profit to grow at a CAGR of around 21% each over FY 2013 and 15 expected. We maintain the buy rating on the stock, and we have set a price target of rupees 1,231. Technically, Divi's might find a support at around 955 and 905, and similarly the resistance is at 1065 and 1151, which is the second resistance for Divi's. That's it, friends. Happy investing and wishing you all a very happy and a safe Diwali. Thank you.